A week of price pullbacks and consolidation for three of the four major precious metals. Silver looks to be closing this week with a spot silver price at around $17.50 an ounce. Gold has dropped below the 1,500 support level. Looks like the spot gold price is closing the week around 1,490 fiat Federal Reserve notes per troy ounce. The platinum spot price fell about $10 this week, closing near 950 per ounce. And palladium continues to show the other precious metals their new nominal fiat dollar high future, likely to close trading around 1,610 per troy ounce. Not merely a returning guest, but a returning original host of this SD Metals and Markets podcast, Eric Dubin, drops by to talk financial markets and about some of the craziest news from this week. Things like President Trump tweeting for the Fed to cut not just to 0%, but even nominal negative interest rates ahead. If you think gold loves negative real rates, just imagine what nominal negative rates in the USA could do to the over-leveraged gold derivative complex. A more than 23-year employee, and up until last month, the global head of JP Morgan's precious metals trading desk, he's been on a leave of absence from work. We ponder what that might mean as the U.S. Department of Justice continues its investigation of financial crimes committed for more than a decade at that bank's derivative trading desks. Side note for listeners before we begin, my internet blackout this morning forced me to make this phone call outdoors. Did my best to mix out the background noise, but there'll be a little bit on my end towards the end of the phone call, so advance apologies on that. That all said, we're jumping into this conversation with Eric Dubin right after this brief message from our show's sponsor. SD Bullion is a high-volume physical precious metals dealer here in the USA. If you are acquiring an investment-grade bullion position, be sure to bookmark www.sdbullion.com/deals, where each and every week we source some of the best bullion deals for our over 100,000 customers worldwide. At the bottom right section of our website, you can also easily subscribe to our weekly bullion deals mailing list, where you will receive weekly notifications of valuable product deals that may be exclusive only to our SD Bullion mailing list. Stay tuned to sdbullion.com, the lowest price, period. Welcome to this week's SD Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us today, September 13th, 2019. It's a returning statesman to our long-running bullion podcast. We welcome back Eric Dubin to our show. Eric, on behalf of our longtime listeners and for the new listeners to the show, thank you for coming back and taking the time today.
Oh, it's awesome. It's nice being here. I mean, Doc and I created the show, and you've been doing a great job carrying the bullion workforce, and it's always fun to come back and to talk with you.
Well, that's great. So, Eric, this week, we've had some really interesting events happen this week, and I figured we'd just run through them and kind of just talk about them because there's some of them are rather large and they require a lot of ponderance, and so I don't think it's fully. We don't really know what the after effects would be if we follow through with it. But President Trump tweeted on September 11th. He tweeted the following, and I just read it out just so people understand. It basically has to do with ZIRP and NIRP, zero interest rate policies and negative interest rate policies. So here's what he tweeted. He said, the Federal Reserve should get our interest rates down to zero or less, and we should then start to refinance our debt. Interest costs could be brought way down, while at the same time substantially lengthening the term. We have the great currency power and balance sheet. The USA should always be paying the lowest rate, no inflation. It is only the naivete of Jay Powell and the Federal Reserve that doesn't allow us to do what other countries are already doing, a once-in-a-lifetime opportunity that we are missing because of boneheads. So that was the tweet, and I think it shocked a lot of people. It's very difficult nowadays, I guess, for Trump to shock people on Twitter, but it shocked a lot of people in the financial Twitter space for sure. I want to get your thoughts on what you think is going on here. Obviously, it's pretty blatant. I mean, he's pretty explicit in what he wants. So let's go ahead and start jumping in on it.
Sure. Yeah. Well, the Federal Reserve has always been perceived as being above politics, and that It's just an organization that's completely independent. But the fiction remains that they've been a political institution since nearly their founding. And Trump's aggressive beating on the Fed is something that I frankly welcome, because it draws a spotlight to the fiction that the Fed is not political and that presidents don't try to get the Fed to do their bidding. The whole interest rate paradigm is such that we're already at basically near 500-year lows when it comes to interest rates. And the truth of the matter is if the federal government was to refinance, they would start doing it now. And we're doing the exact opposite. We're having our bond structure increasingly shorter duration bonds, and we haven't been capitalizing on what has been lower interest rates overall. And our debt has been ballooning, and the ECB lowered interest rates this past week, and they're setting the stage for the Federal Reserve to have more freedom to be able to respond to the political pressure that Trump is lobbing their way. And I fully anticipate that the Fed will cut rates. And the ironic thing is it's probably not going to have a huge impact on the long end of the bond curve, and that interest rates are pretty much as where they're going to stay, because as the largest lender of the entire world, the United States' currency is the backdrop of what funds our global liquidity system, and the ECB right behind it as being the second largest currency bloc. So, as having the once called exorbitant privilege of being the world's reserve currency for the time being, it sets up a limitation. We have to have willing lenders to be the largest world borrower. And in order to continue to borrow, we have to have willing lenders. And at some point, that's going to, through the market, get a limitation on just how low interest rates can go. So, we'll see the Fed acquiesce to all this political pressure, in my estimation. I think that this coming election season is going to be probably the ugliest that we've seen in modern era. And that's going to put further pressure on the Fed. And they're going to be like a football being kicked around in the next 9 months.
Now, just a question about the Fed. I mean, aren't they just going to direct monetize the debt at some point instead of just worrying about is there a willing buyer? Won't they just buy it themselves at some point?
Well, yes, and that's what they have been doing, and that's what they did when they resuscitated the financial system after the 2008 crash. They put in QE and bought a lot of really bad 70 cents on the dollar, 50 cents on the dollar assets held by the banks. And that's a direct monetization of debt that just never was really recognized in the financial press. But that can't go on forever, and that will translate into higher prices by the debasement of our currency, right alongside the debt being less burdensome. But when you are the biggest lender in the world, you have a limitation. Our markets are going to be subject to defining interest rates that can't go massively into the negative, because we are the biggest lender of the world.
And just to kind of hammer on that negative interest rate policy point, he brings up in the tweet no inflation. So that proverbial running lie that we don't have enough inflation or we have no inflation, which is, obviously everybody who's done any research on the topic and looked at the Chapwood Index or the Shadow Stats or any of those places and basically lives day to day in the United States knows that we have inflation indeed, and we have inflation compounding on an annual basis of probably 7 to 8%. When you take into things like shelter, food, not cheap food, but actual food that has nutrition in it, just the cost of goods, especially goods that aren't leveraged by technology. We're talking about real things of high quality. Interest rate, the inflation's been going up, 7-6% for decades now. And so I kind of take umbrage with the idea that to have nominal negative interest rates, right? That's one thing. That tells everyone in the world that the system's totally ridiculous. But we've had real negative interest rates now for 2 decades running in the United States.
Right.
And that's essentially what's made the gold price go up 6 times in fiat US dollar value, and that's nothing to where it really should be if the gold price was actually let loose without the derivatives hovering over it and suppressing its price. So, it's just I don't know necessarily whether or not he's going to get his wish. I definitely think he will go back to the zero bound more than likely in the next recession. I don't know exactly the mechanics of how a negative interest rate policy would work, and I really don't understand how the people on the street. I mean, if they had to pay J.P. Morgan to keep their money in that bank, I mean, most people with common sense would just start taking their cash out. To me, you'll have to get ahead of it because they'll probably put withdrawal limits on the amount of cash you can get. But strange times, Eric. It's just, we have all this, it's like getting gaslit day in, day out. We've had inflation for 2 decades now. And looking back on it, when you do that, the compounding effect of that after 2 decades is tremendous. I mean, you can write off like half your debt if you do something like that, and that's basically what the U.S. has been doing. I mean, it's absolutely amazing. I mean, the last time we really had, like, think about it just in your own personal life. Like, when was the last time you went to a bank, put fiat U.S. dollars in the bank, and they said they're going to pay you this interest rate, and that interest rate was actually higher than what the inflation rate was? I mean, in my lifetime, when I had money to save in the 90s and onward, basically since the mid-90s, like when I was in like 8th grade, you could get an interest rate that was somewhat near inflation, but that's not been the case for a long time.
Yeah, and that's going to undermine confidence. When equity markets go through a natural process of big correction leading to a bear market, it's going to change assumptions on the way people look at the negative interest rate paradigm and whether or not the Federal Reserve and other central banks can come to the rescue of the system like they did in 2008. We're at a much lower level of interest rates across the board, and they don't have the dry kindling to save the system when the stock market rolls over. And trees don't grow to the sky. The equity markets have already given shots across the bow. In the beginning of this year, we saw a very major correction to even touch the level of a technically defined bear market with a 20% down. We're going to see that as the presidential election continues to undermine overall confidence, as the illusion of our economy being strong is more apparent to people, and as the frictions with trade frictions continue. We've been in a long-term upward cycle that's been fueled by credit. And this economic upturn is largely a fiction, and it's one of the longest that we've seen in modern era, and it's rolling over right now. We can see it in statistics. We could see it in the way people were responding with the bond market. From the beginning of this year to only a few weeks ago, we crashed all the way down on the 10-year to about 1.5%, up from over 3% earlier. That is a gigantic move in the bond market, and it shows that bond market's some 6 times larger than the equity market in the United States, and it shows where people are putting their money, where their mouth is. They're running to the safety of shorter-term duration bonds as a place to hide, and that's where the smart money moves first. And I think we're going to have a pretty lousy Christmas season, and retail in the United States is 65% of the U.S. economy. When that happens, people are going to second guess what's going on in our economy, and they're not going to believe the hoodlum that's in the mainstream media about, how strong our economy is vis-a-vis the rest of the world. It doesn't really do us much good if we're the best-looking horse in a glue factory, and that's where we are. So one of the strongest correlations to precious metals is how standard equities are doing in the United States. And for the most part, with the exception of mid this year, precious metals have been sleeping in the North American economy, North American market. And I think that's going to turn around when our equity markets roll over and people actually believe that we're in a bear market. We have so much complacency right now.
Yeah, and just looking around the world, let's talk real quickly about the nominal gold price highs that we are seeing. I mean, up north in the resource strong Canadians, gold price is at a new nominal record high. Same with the euro. That happened this week. You probably didn't hear any news about that, but not many headlines. But that happened. I'm looking. I think the pound. We've already had that because of all the Brexit issues and devaluing the pound a lot. I think there's only a few currencies out there, and the most important, obviously, the U.S. dollar. You get to 1900 and past it, that essentially becomes support, and then all of a sudden you start running into some crazy numbers, right? And once you get $2,000s, $3,000 gold, I mean, that makes some people feel crazy, in terms of the price. But that's likely where we're headed. I mean, it's already happening in virtually all the other major, a lot of major currencies outside the United States. I think the only few laggards are, I mean, Japanese yen is not there just yet. It's almost Swiss franc, perhaps. I mean, there's only a couple, right? So we're not that far away. Maybe we could turn this conversation a little bit toward the silver side. Obviously, there was big news this week for those people out there who pay much attention to the allegations of J.P. Morgan's been manipulating precious metal markets for well over a decade now, ever since they overtook Bear Stearns' bankrupt carcass and took their alleged naked short position on. J.P. Morgan has had a pretty firm fist, it seems, since 2011. They started the COMEX warehouse, but in the last couple of years, a couple of their traders got in trouble with the U.S. Department of Justice for spoofing. I think late 2018, we had one guy get busted, and then just about a month ago, another guy got busted. I've interviewed Ted Butler, but pretty much any time this happens. But this news that came out this week is the biggest news because it's exactly what Ted and pretty much anybody who read what the Department of Justice was saying. It wasn't just simply these small fry traders, who were, trying to make their Christmas bonus by, spoofing some trades here or there. This was systematic. And that was the allegation. If you read the Department of Justice internet, the website. So we have this week. What happened? Reuters, they basically report that the global head of J.P. Morgan's precious metal trading desk, a guy who's been there for 23 years, just over 23 years. Last month, he took a leave of absence from his desk. So what exactly does that mean? No files have been charged yet, et cetera, et cetera. But, I mean, to me, I take that as, the executives or the powers that be at J.P. Morgan are like, all right, buddy, you're going to have to take a walk now that you're getting investigated by the Department of Justice. We're going to have arm's length henceforth. So this guy could be in real deep doo-doo because the other two have been singing. My assumption is that they've been complying with the Department of Justice. So my hunch is that Department of Justice wants some executive heads. And that likely has gone up the chain to the people who were perhaps potentially conscious of all the rot that was happening in that division of the J.P. Morgan Commercial Bank. So I know it's a long tangent, but I kind of wanted to update our listeners on it. Any thoughts you may have about that story?
Well, I'm hopeful that they're going to go after more than just issues like spoofing. I mean, when the news broke that J.P. Morgan was being investigated so many years ago and that it looked like the Justice Department was going to be serious and going after manipulation, as soon as they limited their focus to spoofing, it was apparent that there was a limited hangout. Maybe that's changing now. I don't know. I mean, we should probably define as well what spoofing is for our listeners that don't know.
Sure.
That's where traders will insert into a global market system like a COMEX system a price of willing to buy or willing to sell, but then take it away almost immediately thereafter. And it signals to other traders what the market is doing, and if they take it as a real order, they'll change their behavior. And spoofing is a way of changing the way perceptions are about what's going on in the marketplace. And JP Morgan had made a systematic effort to manipulate markets by using spoofing and coordinating with traders, and they were all aware that that's what was going on. And that's not really the main mechanism behind what has been suppressing the price of silver and gold. It's been games being played with inventories and the delivery of physical inventory at strategic times and things like this that outright manipulate the market. So I'm always skeptical when I see such a focus on the Justice Department going after crimes like spoofing, which is a crime. There's no doubt about that, but it's not really, it's almost a distraction to make that being where people pay attention to rather than investigating what are the powerhouses and mechanisms of creating price suppression in gold and silver. But, we don't know for sure why the guy left. And it could very well be that he's getting pressure from up top and they want to create a little bit more wiggle room vis-a-vis the investigators. And let's hope that that's exactly what's going on. Blythe Masters left her position some number of years ago, and the speculation was the same, that the heads are going to roll, and she was jumping ship because she wanted to not be among the rats on the ship as it went down.
Sure.
And who knows where this is going to go now. It's good that they continue to investigate, that's for sure, because there certainly is a lot of fraud in this casino.
Right. Yeah, I mean, it's the hope that you would think that it would go a little bit higher up the chain, because if that was conscious, you would assume that the manager would be conscious and aware of what, not only like probably training the person how to do it, but incentivizing them with bonuses to do it, et cetera, et cetera. So at the fair minimum, even if they get them on spoofing, it's kind of like when you go after the mafia, right?
Yeah.
In the bootlegger days, like how'd they get the mafia, right? You got them on tax evasion. But hey, bare minimum, you freaking got them, right? I mean, that's the difficulty of playing by the rules. When you're dealing with people who aren't playing by the rules, you got to figure out a way to get them one way or another. And so if that is the mechanism to get some of the rot that's happening in JP Morgan, then so be it. And then you got to turn around and you got to look at the position limits and stuff like that. And you got to, if they're so bad, you just got to kick them out, flat out. I mean, I don't know if you'd ever be able to do it, but getting them even out of it, if they just can't, if they can't, or at the minimum, actually putting position limits on and actually making them do it, right? If you listen to Bart Chilton's last interview before he passed away recently, he literally talked about how JP Morgan said they were going to limit their positions and slim them down. A year later, they're like double or triple the size, and he was super pissed. They basically flat out lied to him and his agency. And a year later, what power did he have to do anything? And so, anyways, we'll move on. Let's just talk about silver in general. Let's do a little bit of discussion on what's been happening. Obviously, we had a little bit of a pause and a little bit of a brief drop today. I think we're in the mid 17s, but it's been an exciting summer. Not just for silver, but also for gold prices in the last 4 months. It's been pretty buoyant. So I want to hear what you're thinking on silver.
Well, ever since we hit in June, with gold moving first and silver catching up really quick, we've had a fantastic run, and this is just a period of consolidation, in my opinion. It's normal to have markets take a breather and be hitting the nice big round numbers of gold going over 1,500, silver touching 1975 on an intraday basis. It's not surprising to see it back off once 20 was in sight. So that, combined with the ongoing pressure from powers that be to like to keep a limit on the enthusiasm for precious metals, and then timing their attacks to correspond to where technical signals that people following momentum markets are thinking, well, okay, we've had a really big move. It's normal for us to see some consolidation. All of this happened when everyone was expecting the summer doldrums to come, and the precious metals were going to go absolutely nowhere, and they shot out like a bat out of hell in June and have taken off. And this is just normal trading by my eye. I was fully expecting us to see this kind of a move this summer. And the presidential election is going to be horrible. It's probably going to be the most acrimonious that we've ever seen. And our economy is rolling over, and we have continued trade frictions, and all of these things are going to coalesce to putting the U.S. standard equities market into doldrums, leading into a correction. I think we will have a lousy Christmas selling season, and people are going to wake up and see that the U.S. economy is a lot weaker than it appears, and that though Trump may have been able to convince people that we're the strongest economy worldwide, people are getting the message that Europe's in trouble, the ECB cutting to try to maintain the banking system there and its solvency. All of these things are going to lead to stock markets rolling over worldwide. And I think that, the second half of this year, we're going to see gold and silver move a lot higher, another 15, 20% before the year's out.
So listeners listening probably know this, but ever since the 2008 financial crisis, there have been a lot of laws put in place, financial laws, not just for bank bail-ins, but also for redemption laws for money market funds and stuff like that, and just this huge explosion in passive investing. And so there's a lot of places where people could potentially get hurt in a liquidity crisis. What is that moment you think in the future we're looking at? I mean, it's really hard to say, obviously, but where's that moment where people start saying, give me my money back? When everyone starts saying, give me my money back, they've got the lockdown laws in place. And that basically means, sorry, you can't have your money back until we sort this out type thing. What are we headed toward that? Is that coming?
You mean like the entire banking system being frozen or just stock market crash?
Exactly. I mean, the liquidity event where the upside down pyramid starts to work out, and you start to see John Exer's pyramid,
Yeah.
actually come to fruition, where you have a true spillover event type scenario, and then sorry, the financial markets close for a few weeks while we sort this out.
If we got to a point where it would be a number of weeks with the markets closed, I think it would be just total pandemonium, and the you get riots in the streets and things like that. I mean, John Paulson, Secretary of the Treasury at the time of the 2008 crash, was banging the door of leading Congress people saying, hey, we're going to have riots, and we're within hours of the financial system freezing up when the commercial credit market froze up in October of 2008. I mean, it was a pretty scary time, and that's what they were using politically to wedge through the very first of the financial bailout programs. So, they have given a lot of the powers that be, and the financial walks within the Federal Reserve and the Treasury Department have given a lot of thought and have developed contingency plans that are off the shelf, ready to go, to have bail-ins, to have stock market holidays. And if our cascade of financial assets begin to take the same kind of route that they were doing in September, October of 2008, they for sure would do that bank holiday strategy and trying to shut down things and have not just single large money market funds shut the door on redemptions, but to have the entire system shut down. So, it's going to take a lot for confidence to be lost at that magnitude. It certainly is possible, given the rot that we have in our financial system and the level of over-indebtedness and so many financial players and institutions as large as Deutsche Bank being in the position that they are. I mean, the potential for that kind of chain reaction certainly exists. The authorities are smarter, relatively speaking, in terms of being able to know how to shut things like that down. They've been doing that this whole time since the 2008 crash. They've bailed out Deutsche Bank. They have put out fires within the European banking system, and prior to that in the United States. It's been enough. It's kept the system up and running. It's kept confidence alive. People are not recognizing the degree to which these underlying problems exist. But when the economic cycle begins to eat away at confidence and the asset values of U.S. equities go down, that's going to add pressure, and we'll always get ever more closer to those kind of tipping point, Exeter pyramid reversing events. It's impossible to say we're going to crash that level and have a 1930s style depression. The strategy to deal with it, no matter what, is to just have your assets appropriately placed with a healthy position in precious metals and a decent sized position in shorter term duration T-bonds, or T-bills, 3-month treasuries, things like that. Real assets.
Something very close to cash if you need, to have some optionality if you want to buy something that looks like it's on sale, etc.
And, keeping your debt levels low, just being sober in such uncertain times where everyone and their dog thinks that everything's perfect. I mean, the level of complacency right now is near peak.
So the ECB this past week with Draghi on his way out, that was an interesting couple clips I saw of him talking at the, basically saying like, we did everything right, but these all weird side effects. It's because fiscally we didn't do the things that we needed to do. So he's essentially paving the way for Lagarde to be coming in, who wants to do some fiscal, Lord knows what in the EU, what they're going to be doing on the fiscal side. But what are your thoughts? Is Lagarde going to become the head of the ECB, and what are you expecting out of her?
I would say, yeah, I'd imagine she's going to be the next ECB head, and she has a decent amount of political capital and is respected among the banking community. So she'll probably be the one who's at the top. And fiscally, who knows? I mean, that's a really good question. What Europe can do as a disparate group of different economies and whatnot. Sometimes they just barely agree on anything, and it's easier to do financial engineering and that kind of monetary policy coordination, but when it comes to fiscal policy, it's going to be a lot more difficult. And Draghi was famous for saying that he would do whatever it takes to save the banking system, and they really haven't been able to clean up the rot, particularly in the Italian banking system. Problems still exist. It's just been swept under the rug.
Yeah, it makes sense that you'd bring in an IMF operator, someone who's going to have to make some tough political choices in terms of who gets their haircut, who gets bankrupted, who gets bailed in, etc. She may be just the woman for the job. Well, Eric, I want to close it out by giving listeners a way to potentially find you and hear more of your thoughts moving ahead. I'd like to have you come back more often if you would. If you could take some time out, that'd be fun. Maybe we could do some two-person interviews on other folks. That would be always exciting too. But give the listeners a way to find you if you can do that.
I'd like to do that, James. It'd be nice to come back and plug in with the audience, and we'll do that definitely going forward. At the moment, probably the easiest way to just keep track of what I'm doing on a day-to-day, and I don't publish all the time, but I will be stepping up and doing a lot more stuff in public, would be to follow my Facebook page, and that would be facebook.com/Eric Dubin with a C, and my last name is Dubin. So facebook.com/Eric Dubin.
Well, Eric, on behalf of all, especially our older listeners who remember you and Doc back when you guys started this show, and for years you guys worked on this show and built a loyal following, I want to thank you for all those years you put into hard work, and thanks for taking the time today and coming back, and hopefully we can talk soon.
Sounds great. Thanks.